Namaskar. Good morning, everyone. A very large and sincere token of gratitude to Naredco Maharashtra for giving family offices due cognizance and inviting us to speak today to all of you. And on a personal note, Dr. Hiranandani, my grandfather was one of the earliest members in CREDAI back in the day and a founding chairman of the Rajasthan chapter. He shares very fond memories of having learned from you back in the day. So great moment for me to be here and being allowed to speak in front of you. So thank you very much. I'd like to begin with a quote by the legendary Larry Fink of BlackRock. We're living through a period where things that would have defined a decade have become routine. War with global repercussions, trillion-dollar companies, a fundamental reordering of international trade, and the advent of the most important technology since at least the computer. With that backdrop, I would like to say that things keep changing. Stock markets crash, commodities and metals fluctuate, but the one asset class that forges ahead and moves forth is real estate, which ties all of us together and gives a bedrock of stability to the world. And we would like to invite the family offices and the developers that have joined us today on this panel to share their experiences and their thought process going forward of how there can be an intersection created of family offices, institutional capital, coming together with real estate developers and talent to create really first of its kind, world-class projects in India going ahead. So thank you, everyone. Thank you for this opportunity. And can I have a round of applause for my panelists? So can I request my panelists to just give a brief introduction to begin with?
Hello, everyone. Good morning. My name is Jaykrit Goyal, and I'm a director at Pristine Properties. We are headquartered in Pune, and we have been in the real estate industry since the last 40 years. We actually just completed 40 years last year. Our company has diversified. It started with residential earlier, predominantly, and now we've ventured out into warehousing, hospitality, and other avenues as well.
Good morning, everyone. I'm Rinal Mittal. I'm the director of Unity Group. So we have two companies. One is called Unity Group, which is Delhi-focused. The other one's Homeland Group, which is Punjab-focused. So we're doing residential, we do retail mall centers, we do office buildings. We're now starting to go more towards tier 2, tier 3 cities, much smaller, more ingrown, and trying to focus on the plotting segment as well.
Hello, good morning, everyone. Avinash Dulani here. I've been a finance professional and have been working with family offices for the last 15 odd years. Currently helping Thakur Family Office set up this whole investment vehicle that they want to deploy. Looking at, so I would like to call family offices jack of all trades and master of none. We have spread across a lot. We try and look at each and every asset class. That is what my role is, yeah.
Yeah, thank you. My name is Abhimanyu Sofat. I am the CIO of Dempo Family Office. Dempo is based in Goa. We have a real estate business in Goa. And on the investment side, we've invested in multiple asset classes into various stages in real estate as well. So happy to be here and share my thoughts on real estate as one of the opportunities and how do we look at real estate from an investment perspective. Thank you.
Perfect. Thank you very much. And last but not the least, I'm Shashwat Gupta. I'm a director at Anukampa Group, a third-generation promoter. Been fortunate enough, as Sir mentioned, to not be the very first-gen promoter and have not gone through the kind of difficulties that the previous generations did. But we've been practicing in Rajasthan for 48 years now, delivered over 30 million square feet out there across a spectrum of assets. And we also started a family office around 8 years back, investing actively in private equity, startups, and stocks, hedge funds. So have had the opportunity to get a little bit of experience on both sides of the aisle. So to begin with, I think let's give the audience some context, starting with the family offices. How is it that family offices in India, and both the Thakur family office and the Dempo family office are fairly mature, august family offices? how is it that they are viewing real estate as an asset class today? In fact, I know on the Dempo family office side, you all are developing a hotel. You just signed a massive 5-star hotel deal in Goa as well, where you're actively investing and developing it. So how do you guys view real estate today? And is there a particular niche in which you're looking forward to invest and work with developers?
Sure. So in case of Dempo, like at one point of time, we have some 5-6 projects which are there in Goa. You mentioned about the hotel project. We have some villas also coming up. As per investment, we have done some investments directly with some developers, investing in NCDs. We have invested in couple of real estate fund. The experience on those sides has not been very great, to be honest with you, in last 10 years. But what we have found is that if we have invested, say, for example, in Bombay on the real estate side, taken an office space in Bombay, that has yielded very good return for us. We have recently invested in an office yield fund. So that is one stage before a REIT. So the advantage that personally I felt, when you are investing in these kind of products is that you get an additional 200-300 basis point additional return relative to a REIT when you invest in. Secondly, because at the fund level, you can do a leverage of close to 50%, which is not possible in case of a REIT where it is around a 25% kind of leverage. So that gives in that additional kicker. And one of the main thing I think so why people are now getting into real estate from funds is the entire taxation change which has happened on the side of the debt funds. So our allocation on the debt side, that is now moving towards the real estate side. So say, for example, the kind of funds I'm talking about, around 70-75% of whatever return I'm getting, that is in terms of long-term capital gains. Rather than in case, earlier it used to be that the interest income was something that everyone was looking at. Now, interest income is very low. So effectively, versus say a performing credit fund, on a like-to-like basis, if I want to make a return of more than say 9% on my fixed income allocation, so these funds are very attractive. So our focus right now from an investment perspective is wherever there is a rental yield, already a project is developed, and you have rental coming, let's go and explore those investments rather than looking at riskier things that we anyway are doing in our operating business. Yeah.
Abhimanyu, I guess you haven't left anything for me to speak, but let me address it this way. I, as a CIO and a fiduciary of Thakur Family Office, I'm trying to build a portfolio from scratch. So how I have approached this, basically I'm looking at what I can place it in my core bucket, which is predominantly REITs and InvITs, and gradually trying to go up the value chain. When I say go up the value chain is basically trying to see how I can better these yields. When I say better these yields, I am looking at pre-REIT, pre-InvIT funds. I guess there are a lot of guys who have offered, and I'm also trying to stitch a deal, a co-investment deal along with them, because over there I am able to capture the yields much better. Of course, there are certain risks involved, but the return pays off for that. And this is how we are trying to build. I would like to say that we are still trying to figure out what will be the optimal real estate allocation for us at this point. So this is how the whole ladder is stacking up.
Got it. Thank you. And like many of our members in the audience today, Jaikrit and Rinal are next-gen young promoters across their family organizations. So, folks, is there a hesitation to work with outside capital, institutional capital? It comes with a lot more diligence. It comes with a lot more scrutiny, different levels of control. And I know that previous generations perhaps were opposed to the entire idea of having any sort of outside interference in the management of the business. But as folks who've perhaps gotten a little bit more corporate experience and more exposure on the institutional side of things, do you guys share the same hesitation with the previous generations? Or is it more open for you to look at bringing in institutional capital and unlocking a different level of growth?
I would say it's actually, it has of course changed with the newer generation. I think it's much easier to invite foreign capital from institutions per se. This is because, firstly, now we have RERA in place. We have a lot of regulations. Earlier, the execution was also fragmented. Governance was not as firm or as diligent as it is today. So, looking at all such factors, when we have governance in place and when we have other such things which promote the idea of attracting foreign investments, I think it's a very clean environment and it's a very good playground for foreign investors and especially global family offices to come in to India. Secondly, I would also like to say that India being a growing economy, we've just touched the trillion mark and it's just to grow. And like Niranjan sir said, it's just going to compound 12 to 15% on a yearly basis. So if we are looking at such kind of developments and if with such a rapid growth, I think it's only justified that we should look at global family offices and global investments pouring in India. Thank you.
So for us, we've actually gone through the transition where our family was not okay with even debt. It was purely family money. As Rajanji said earlier, that हमें मीठा हजम नहीं होता था. So we went from that like not having debt to finally accepting debt in multiple forms. And then eventually you reach a point where you need kind of institutional capital on your books, but you're not okay to bring them in your equity table. So we're kind of transitioning at that point now where our governance is cleaned up. We're very transparent in all aspects. Obviously, we've been kind of, we call it RERA compliant since last 30 years of our operation. We've been always very transparent with our customers on the timelines, the quality, everything, but there was no way of reporting it earlier. But now we're actually seeing that institutions are looking at us. They are coming to us to kind of work with us. But we still don't want to give up a board seat for them. So that is the kind of phase we are in. In that way, again, like the issue with real estate is that banks, NBFCs are not funding your land. So unless you're going for a structured deal, a JV or a JDA, or a redevelopment here, it is very unlikely you will get like good access to financial capital. So what we've done is now we've started working with certain family offices where they bring in the capital as a structured debt of sort, where the debt then later on converts to area within that project itself. So they get a good deal, we get a good deal as well.
That's a very interesting structure. So again, over to Avinash and Abhimanyu. My question is, across my conversations with multiple institutions and family offices, the thing is, when you're sitting on capital, there's multiple ways to get exposure to real estate, right? Or the boom of real estate, so to speak. You don't just necessarily have to play it by investing in a project or working with a developer. You can go through the debt route. You can go through investing in listed larger developers, or you can play proxy bets, picks and shovel plays, so to speak, like construction material companies. So how do you guys kind of segregate across those opportunities, and what is it that will bring you to the table to actually co-invest with a developer in developing a project versus going with these other slightly less risky opportunities such as investing in construction material firms or large listed developers?
I guess the first question, let me first address the second question. You are saying, how will what is the better route, equity or a debt? So, over the last 5-6 years, I guess this industry has matured. I would say both the sides, the family offices as well as developers. And there are more structured solutions available to us. Over the last 5-7 years, what we have realized is when you try and partner with an asset which is intended to be sold, the outcomes are not good. There could be delay in sales velocity and various other things. There are various other challenges. So the sweet spot for us has always been rent generating asset. And that is I guess Abhimanyu also touched upon this point, that is a classical alternate to a debt. Post this taxation that was changed in debt, we believe to capture better post-tax yields, it is better that we go into a rent generating asset. So that is the sweet spot that we are trying to evaluate. What will what developer has to do to attract family office capital? I would say see, I have heard lot of pitches, and all those pitches always promises me the upside, 20% IRR, 25% IRR. But you have to understand family office is in a wealth preservation mode, right? The key point for me is always, is my risk protected if everything is to go down? Is my capital protected if everything is to go down? Once I have that comfort is when I can build the thesis around, okay, even in the worst case situation, my IRRs could be low, but in best case situation, I can generate much better. So the pitch from the developer has to change. Let me go back to your first question. Can you repeat that once again?
So the question was, how do you segregate across multiple opportunities to invest in real estate? Could be investing in a construction materials company as a proxy bet, or a listed large developer with more robust cash flows, versus doing a direct investment in a project with a developer.
I guess I would like to bucket it into a debt and an equity play, not this way. When it comes to equity, I would prefer it to play the shovels and all those, basically trying to buy equity of cement company, construction related, tiles company, or whatever company that is linked to the consumption of real estate. That is how I'll play my equity bucket, not going and partnering with the real estate guys. Of course, there is pre-REIT, pre-InvIT, which is more of a debt play for us, right? And I'm very much comfortable coming at the execution stage where there is execution risk, there is leasing risk there, but I guess the rentals, the returns should compensate for the risk that I'm going to take. So that's more of a debt play. This is how we have structured the book in our family office.
Yeah. So I kind of agree. When I'm looking at a company which is an ancillary to real estate, it has to be a view on overall real estate sector, and plus what exactly that company is doing. And then you have to look at the underlying risk. Like for example, today you have all the tile manufacturers facing challenges with regard to gas, the entire the Morbi ecosystem. So obviously you will look at them on a standalone basis, those opportunities. Second thing that one needs to look at is on the interest rate level. See, a lot of the products today which are there in the market are based on a compression of cap rates. So the wealth manager is coming to you and saying that you will make X return, but plus in above of that there will be an X compression happening in this particular product, because as you transition from a developer selling it then to a private fund, and then that money going into a REIT kind of a structure. Now, entire ecosystem today, you have thought that, this is the kind of compression that will happen, in terms of yield. So that is what is being sold. Now, at some point of time, a developer would say, why would the entire Malai be taken by, the REIT guy? Let me, even if I have a right of, first, still I will like to get a better part of the yield. So those are the things which will change. And secondly, the interest rates have really gone up a lot in last 4 or 5 months, which no one is talking about, at least on the 10-year. The actual interest rates have not, gone up, what we are paying today, but the 10-year is clearly indicating. So that is another challenge which we are going to face going forward as an industry, that when yield goes up, the interest rates goes up, then that yield compression is unlikely to happen. And that will lead to a lower rate. Having said that, I think so the kind of money which can be raised from these products, it's a flywheel now happening. Something like a knowledge REIT is a 50,000 crore REIT. A Bagmane, which is just coming up in next 1 or 2 months as a REIT, they are planning to raise close to 35,000 crores. So the amount of money which is being actually raised is humongous, and I see that trend going forward to increase only going forward. But the key is stability of earnings. So then you get the debt allocation part from investors, which is a huge opportunity, especially because a lot of these senior citizens, for example, they want a liquid investment. Now, if you go and buy some property, they will have a headache of, doing the registration, getting the tenant up, down, finding a broker. For them, it's very simple now. Just go and buy a REIT. every year 5% appreciation happening. There's a lock-in period. There's a lead discount model which is available in the market. So many things are happening on the institutional level which can really bring in, a significant change in the overall allocation of wealth in the country. Thank you.
Thank you. So there are some brilliant examples of large institutional funds working with developers to create landmark projects. So here in Mumbai, just yesterday I was at this development called Altimus in Worli, which is apparently a joint venture between GIC, the Singapore-based sovereign fund, and the K. Raheja Group. And it is, I think, eventually going to turn into more of a platform-like partnership between a developer and a fund rather than just a one-off project-based relationship. So as you and Mrinal come, into your own and start taking control of the business, do you think there are certain things that you can do to make yourself more attractive to institutional capital and and get them to think of doing a platform-like partnership with you where they do multiple engagements versus a one-off project?
I think here it's when we are looking at such institutional investors or family offices, two main things. I see them as any other flat buyer coming in to buy a flat. So now, the one thing, first and foremost, what they need to build is trust. Now, what is trust and how does it come? Trust is when you show that faith that this company has a vision and it will do something in the next 5 to 10 years. And what are the things that fuel it? So that could be consistency in deliveries, or maybe transparency in the policies that you have or in the way you work. So all such things, I think, fuel trust. And once I think trust is built, it's easier for both the organizations, be it the family office or be it the developer side, to carry on business, because now they know what we are going to do per se, and I have shown them my vision. They know what my ideology is. And thirdly, I would also like to say here is that instead of having a one-off relationship where, such institutions come in just for the sake of one project, I feel it's much more comfortable. It's a better risk management even for the family office side when they are backing the developer on a facet of multiple projects. If it's one project, it's secluded to one land. So maybe that one land cannot, will not deliver or will not perform as it was promised or as was predicted. But if it's across a bigger cap table, it's much more easier, because when you balance it out, it's easier for the institution to show a rate of return when they're working with a developer on a series of projects and not just one.
So I agree, but one of the biggest things is that a developer needs to offer enough assets for an institution to be interested. So, for example, I have 2 assets right now. I go to an institution. It is very unlikely that they would want to come into a platform-like partnership with me. What would work well for them is to absorb that asset into an existing InvIT or a REIT or whatever asset class, right? A company would rather want to acquire me rather than work with me in that case. Be it an institution, a pure financial institution, or a developer institution, right? So I think the stage at which the development company is also really matters in that case. So again, but transparency is very important. If you are not just not being RERA compliant would be enough then. You need to be offering them like a board seat, for example. You need to be offering them very open access to your books. Only then the institutions will actually be interested in working with you. So also, if you're in a pure residential kind of asset play, it is very difficult for an institution to enter and be interested in your company so much. Instead, if you have a lease kind of development asset, so like let's say malls or office buildings, it gives you a lot more opportunity because there is an appreciation, and then there's the rental model that works well for them. So I think that really matters as well, for if an institution would be interested or not.
Brilliant. Thank you.
I'd just like to add to Mrinal. So, it's one thing to have a vision and to show an ideology, but it's also one where you show where a developer shows an institutional lender the appetite to take on risks or the appetite to take upon work. So if today I as Pristine take upon 3-4 projects and get an investor on board, and then tomorrow I stop working, I stop taking up on opportunities. So I think that trust will not remain the same, or it won't be fruitful for the institution to have shown interest, because what they want is a growth rate with the developer also. So as we know, the industry is flourishing, but if the company they're working with is not flourishing, I don't think it's going to be fruitful for them in the end.
So there are some examples in recent times of what old school developer families have been able to do by spinning off businesses and making them, more robust on the corporate governance side. And they've been able to attract institutional capital in a very big way. So for example, what the Virvani family in Bangalore did with WeWork, or what the Reheja group has done with Chalet Hospitality, right? So if you can spin off a certain thematic part of your business and create a more corporate, robustly governed company around that, do you think family offices are more interested in tying up with a developer or investing in a more meaningful way if there is a spin-off with a thematic business that's going to grow and run more like a corporate entity rather than a purely promoter-driven business like the core business?
No, absolutely, that's happening, and especially I would say that the foreign funds, the Blackstones of the world, the Brookfields of the world, those are the guys who are taking a lead in terms of getting these kind of structures in place. And that is something then family office through, the various funds which these guys bring in can really participate in these kind of, stuff which is happening on the real estate side. So I would say the answer to that would be yes.
So let me address this in a completely different manner. See, how does a family office take a lead position in investment? They usually start with an external fund manager who can manage capital for them. They then start partnering with him in the deals. And gradually, once they have know-how, once they have enough knowledge, they'll start going and stitching up deals on their own, right? So definitely, the reason why family offices have stayed away from these real estate platforms is because of complex structures. If real estate developers are able to simplify these complex structures and put up a simpler structure for us to understand, I'll not be surprised if family office start doing this on their own rather than going through a fund manager channel. This is all about time. Yeah.
Yeah, because there are startups like the Hostler which are able to raise institutional capital, your co-living startups, right? Lots of startups with promoters essentially who have had no experience in real estate whatsoever are coming out showing good proof of concept and are able to raise a huge amount of institutional capital.
I think so. One change which has happened, to be honest, in last 1.5 years from the family office perspective, and this is not related only to real estate, is a shift from focus from IRR to DPI. So that's a big change which has happened. Earlier we've invested in a lot of funds for 10, 12 years, and the fund manager used to come and say that I've made 25, 30% return for you. And when you see the net number, post carry, you end up with probably 13 to 15% kind of a return, to be honest with you. Some of the real estate funds may be lower sometimes, depends on which particular fund that is there. So DPI now has become a very critical thing, and most of the private equity funds are typically from 10-year perspective, 10 plus 2 years, 12 years, and then also you're not sure whether you will get back your entire capital at that particular point of time. So with these new real estate funds which are coming up, and you can, so REITs obviously you give instant liquidity to you, but a lot of the other funds which are coming, which is typically the 5 to 6 year kind of a bracket. I think so that is more of a sweet spot, because a lot of the principal promoters are saying that, when would I get back my money? Even after a decade of investment, if I am able to make just double-digit kind of lower teens kind of returns, does it make sense for me to put money there? Rather, I'll go and invest in a Nifty only, which will give me a similar kind of return and where liquidity is very high. I think so that is something that one needs to think when looking at the family office capital, that the patience of family offices in terms of getting back money, that has reduced a bit because of what has happened in last 10 years. They are ready to put in money, but the time period in terms of when to get back that money, that has reduced now in terms of mindset in last 1.5 years.
Does that also change what stage you're willing to come in at with your financing? That's why you probably do not wish to come in at a very early stage.
I guess that's where the portfolio allocation stands, core, core plus, and there is opportunistic. Gradually, as family offices mature in this real estate class, we will start looking at opportunities, and that is when all these high risk category where there is execution risk, there is developer risk, there is leasing risk and approval risk, all the things are there. So we will start doing all those deals very soon.
What about,
Sorry, Shashwat. So another thing that happens is a lot of promoter-driven, like family-driven family offices would also invest in the land part itself. So rather than coming in as an institution later, they would just be financing the land part and they'll bring in a developer. Over there, they're definitely taking a bigger risk, but they're also getting better returns. So that's also an opportunity for a lot of them. But usually that happens that the family is very involved in the family office as compared to a professional running it.
So just one point, today there are funds which are available for redevelopment who are working with developers only focused on redevelopment. Today there are funds, what they are doing, so one of the funds in South India, what they are doing is when they are going to the developer, one is a RERA approved project, one is a non-RERA approved project. So they are taking both the projects at one go and then giving the funding to them. So a lot of those kind of things are being done by funds to protect themselves against a risk that, this project doesn't take off. So I see that happen, and with this particular fund, they've already have 5 series already. So 4 series, there was no risk. The fund making a return of close to 14-15% kind of a return. You have a continuous rate of investors again reinvesting in the next funds. Typically, the fund would be for a period of 3.5-4 year kind of a period. So I see that kind of funds also doing pretty well in the current way that we are talking, where the focus is shifting from IRR to DPI.
what about concentration risk? So real estate typically tends to be an asset class where you only wish to invest in your immediate locality or near your base of operations. Perhaps for regular investors or regular business people, that tends to be the way that they operate because they don't have the bandwidth to do due diligence in separate markets spanning across multiple geographies. But with family offices which have dedicated teams for research and due diligence, have you seen this across your investing or that of your peers where you're looking at newer markets away from your base of operations?
Again, it all boils down to simplification of structure. Classic example, family offices have started taking liking towards REITs. And REIT is a diversified asset play. They might have an asset in North India, South India, and all across the India map. Currently, we are only looking at home turf. The reason being is because of complex structure. We need it to be closer to our home. We want it to be monitorable. We want all the access to the data, to the people, have an interaction, and that is where the reason is that we are very, very concentrated in the home turf. As and when the institutionalization of all these products, all these opportunities will happen, I believe the diversification theme will play out where family office will be indifferent where the developer is.
I think so. If the property is in a CBD, in top 8 cities of the country, I don't see that as a bias if you're going through an institutional framework. You have a manager. However, if the investor, the company is looking at, the fund is looking at, B series, city B or D or C or something of that sort, I think still there will be a hesitance, and rather the person, the family office will focus on the local market knowledge rather than going to that, simply because they don't have enough information. Access to information is a bit low.
Is there truly any focus on ESG? And this, I've opened the question to all 4 of you all. Mrinal and Jaikrith, in terms of your development, Is there a true focus on ESG, coming up with more sustainable materials, actually tracking carbon emissions across your developments? Do you think that there is something that can be done in a cost-effective manner to ensure these kinds of practices? And to Avinash and Abhimanyu, I would say, from a realistic standpoint, is it something that a family office truly factors in while investing if a developer is using ESG and friendly,
I
sustainable
don't think
practices?
so, to be
Unfortunately,
honest.
no.
And Trump has ensured that even you don't look at it at all. It's diluted a lot.
Actually, with that question there, Akshat, you've literally like tickled my fancy because I think sustainability is the future in real estate, and we should walk towards it because, as we all would know and or should know, actually, real estate across or real estate globally contributes to the largest amount of carbon emissions. So as a whole, be it from cement production to construction in general. So I would say sustainability should be, we should imbibe it in our daily lives. But in terms of real estate, if I see, it is not just to factor or to make the industry better. It can also be a USP, a unique selling point with institutional lenders when we get them in, because a lot of, it just does not work towards the ESG part on the developer. It also works with that of the family office because they are now investing into something that is sustainable. So, it feels good on the part of the family office also and that of the developer also. So I would say sustainability is really there, and at Pristine we are really now, whenever I take multiple trips globally so that, I can come across various sustainable raw materials or sustainable practices that can be carried out on construction sites. So yes, we do heavily take part or take interests in all of this and in raw materials.
So in Punjab, for example, we get about like 15% free FSI, if I'm not wrong, for like 10 to 15%. If you're IGBC rated, silver, gold, and platinum have different free FSI that you get. But Haryana has a similar policy. You get 5% free FSI there. Delhi is just about to introduce a new policy for it. With things like that, it is not a choice, but like you kind of want to get that free FSI, right? So on one side, you have that making a green building actually incentivize that. So definitely that is a big plus. But on the flip side, if you're building a commercial building where you have tenants, a corporate, like an MNC or any of these foreign companies coming there, or if you have, let's say, the Tata Group or any of these Aditya Birla groups coming in for leasing, they typically need you to have a green building because they need to show that again in their reports further. So it makes it easier for us to lease out our buildings then, but also, and we get free FSI. So it is definitely a win-win for us that way. In the residential side though, it is a pure marketing play for us. If you build a green building, we can kind of tell them that the maintenance costs are usually a little lower, but then there's a bigger capex to it, like a 4 to 5% increase in cost usually happens for us. So we're able to absorb it in our prices though, so it is not really a big deal because your 4 to 5% extra happens only on your cost price, the building cost price, rather than on your whole project price. But your revenue incentivization, if you even add like a 1% extra revenue to it, you're already making that gains there. And then just the extra incentive of having a reduced maintenance cost for your customers kind of makes them feel better about that building in some way.
Thank you. So to close it off, one question again open to all four of you, but in a slightly different way. So Avinash and Abhimanyu, one piece of advice for all the developers in the room: what is it that they can do in terms of corporate governance, future business research, or just any single thing that you think that developers can do to make themselves more friendly to institutional capital?
So, I think so, as Mr. Hiranani mentioned that, going forward, real estate is expected to do pretty well, 13-15% growth he talked about. And the current war situation and what has happened, say for example in Dubai, I see a lot of capital now coming to real estate back. So that is something very good. Now, if you are going to provide a similar kind of ecosystem, what is there in Dubai? Like, for example, you mentioned about, branded agency and a lot of those kind of things. If those things are incorporated in India, I think so. There'll be a new set of people who are ready to come back to India, and the GCC, for example, is something which is a very big opportunity, which is there. And with those kind of opportunities coming up, if what is said to the end customer that ultimately gets delivered, that creates brand to all stakeholders, right? And once that does, and one of the stakeholders is investors. So as investors, if one finds that, whatever is the promise which the developer has made, no, I'm sure everything is not in the developer's hand, but things, as everyone talked in the morning, that things have improved a lot in terms of, getting approvals and all. So if those things happen, I'm sure that incrementally the percentage of allocation would have to increase only to real estate relative to other asset classes because it's volatile. All the other assets are volatile. There is an emotional angle investing in real estate. So roti, kapra, makan, the makan is very important. If you either have makan or you have your workplace, which is your office. So I don't see anything which looks negative, and as the corporate governance is clearly improving in the sector and institutionalization is happening, I think so the sector is for a good time going forward.
One single piece of advice is don't consider family offices as loan sharks. Consider them as a partner to your development. I have seen a lot of developers. So if you if you think that these guys are all loan sharks, you will end up attracting those kind of people who will behave that way when they invest with you. But if you start opening up your books, you simplify the structure, you make it a bespoke solution for them, I guess that is when you will start attracting them on the cap table or on the loan table. Yeah.
Just to quickly wrap it up, Jaikrit and Mrinal, what is it the developers are looking for from institutional capital providers? Because there is a slight mismatch. The institutional guys, they want to come in when a lot of the risk is already managed, right? They want to come in when there's some sort of yield coming in, or when the project is close to completion and return of capital is quite sorted, whereas developers typically need capital at the beginning phases, land acquisition and development. So what is it that institutional capital guys need to understand and learn to be better investors and partners for real estate developers?
See, I think trust goes both ways. Now, I initially said that I can, developers can garner trust by, deliveries or transparency. But I think it also matters when trust is shown from the other side, because we, of course, on a primitive stage, if we get funding on a primitive stage, it's easier because, then in this case, we'd be sharing the wins or if we lose. But sharing the loss is something that is just, we're just thinking about, but it's only that if there's, if we do it together, if the two organizations do it together and in a very organic way, then I think it's always going to be a win-win situation for both. So on this front, I would like to say that, you clap with both hands. So if I like to get trust, I would also give trust by getting their investments on a primitive stage, because of course it's a help. Now there's so many institutions which do not give loans against loans for buying lands. There's only certain NBFCs that have just started to venture into it, like Piramal amongst some of them. So there's not a lot of institutions that actually help developers buy land. So that is the one stage where it is of utmost importance. Any such investments are of utmost importance for the developer. Yeah.
Typically, institutions are bound by way too many restrictions from the RBI or the SEBI, whichever is applicable to them. So in one way, unless they're out of some of those restrictions, it is very difficult that they'll be able to help us out. Family offices, on the other hand, are typically not really bound by any of those restrictions. They are flexible, they are patient capital. As Avinash said, if you work with them in hand to hand, they will trust you, they will build up with you. and they're okay to find ways with you. They're okay to come in at a land stage, they're okay to come in pre-RERA stage, they're okay to come in post-RERA stage, or like after delivery as well. So they're typically okay to figure out a solution with you. So I think that's a big difference between the banks, the institutions versus the family offices. And the minute the institutions start realizing that this is the family office capital needs to, the institution capital needs to come in this manner that they need to work with us, they'll be able to work with us in a much better way.
Perfect. Thank you so much, guys. And again, thank you to Naredco and Camden for bringing this panel together. We're very grateful for the opportunity to have all of you listen to us. And thank you for the attention. We're all in the room if you want to have a private conversation. Thank you very much, folks.